Okay. Good afternoon to all of you. It's 7:05, so we have given what we call in Spain the 5 minutos, the 5 minutes of cortesia. And it's a great pleasure for me to act as moderator of this interesting conference that we are going to have in CFA Society Spain. First of all, I would like to thank Nicolas Bourdet. His intervention has been key point for having this conference with us. Nicolas Bourdet, who works in capital strategies. And something that we wanted to discuss is value versus growth. As more you know better than me, I say in the last 10, 15 years, in the text of the email, we have said 13 years. I would never say 13 years in a written paper, or even perhaps, but it's true in the last decade or even a bit more, value has underperformed growth. Something that is complete is something is exactly the opposite as the model or the factor model predicts. You know that capital asset pricing model, when it was launched in the 60s, it was a great model, but it didn't work when it was if you wanted to use it as a model to explain the reality. And one way of solving these problems was to add to a single factor, that was the capital asset pricing model. You know, the single factor was the market, to add other factors. So the first step was the three factors model of French and Fama, and these two additional factors. The first one was the size. You know, with the size, small cap was underperformed large caps, even taking consideration not only the return, but also the risk aspect. And the second, David, por favor, puedes inhibir tu micrófono. And the second one was value versus growth. I am not going to define value because when we were preparing this conference, it was a topic that was not easy to define, as is something that I hope the speakers will define what is growth for them, what is value for them. But we are not speaking so much about the factors, so this is not a conference of factor investing, but style investing, okay? We are going to talk about value, about growth as investment style. Let me introduce you the two speakers. The first one is Gerardo Zamorano. Gerardo Zamorano is an analyst and team leader, and he is responsible of the commercial research from Brandes Investment Partners. You know, it's a house really with a deep research, very fundamental. He's also a member of the emerging markets and all cap investment committees. Furthermore, he's a limited partner of Brandes Investment Partners, where he works, and he joined the firm in 1999. Gerardo, I'm a bit surprised because you look much younger so I wouldn't say my whole life that you started to work in 1999. He began his career as investment officer in the Latin American Department of International Finance Corporation. As you know, it's a part of the World Bank Group in 1995. He holds an MBA from the Kellogg Graduate School of Management of Northwestern University and a BSE magna cum laude from the Wharton School of Business of the University of Pennsylvania. And we have also, thank you very much, muchas gracias Gerardo por estar con nosotros. Gerardo, as you can imagine, he speaks a perfect Spanish. Quentin McFarland. Quentin is an analyst and portfolio management at Ceylon Investment Management, a long-only fund manager based in London. Ceylon, the asset management company, invests solely in quality growth equities, which they hold for the long term in concentrated portfolios. This asset management company, was founded in 1989, and they have under 3 billion in assets under management. Quentin joined Ceylon in 2018, having previously worked as an analyst in the European Long-Short Fund at Bluecrest Capital. He started his career at Macquarie Bank, working both in London and Hong Kong. He's graduated Oxford University, and as is the case of Gerardo Zamorano, he is a CFA charter holder. So thank you, Gerardo. Thank you, Quentin, for being with us with all the CFA charter holders of Spain. And the first point that perhaps I will ask you is, and I will ask with you, Quentin. Quentin, how do you define what is a growth stock in your case?
Yeah, well, I think it's very important in this whole discussion to define these carefully, both value and growth, because I think what we're all trying to do, all investors, is, you're all trying to find undervalued companies, invest in them, and see that revaluation come through. I think often the two are sort of reduced to value is investing in cheap companies, and growth is value investing in expensive companies. And I think that is an oversimplification. Although I would say that a lot of the analysis going back over time seems to reduce it to just this level. So really for us, growth investing, I guess for us, where the difference comes is for growth investing, what we're doing is we're saying, okay, this is a company that's growing well, has a strong history of growth, but we believe that it can continue to grow for longer than perhaps people anticipate, or that for even higher growth than people anticipate. And I mean, this maybe is a very simplistic way of looking at it, but for us, value is more likely saying something like the mispricing is coming from people anticipating there to be a worse outcome than what we think will happen. So whereas value, and I'm sure Gerardo will elucidate this much better than I will, is using the valuation as their margin of error. For growth investor, it's the sustainable growth rate that is your margin of error, and it's you saying that this company can continue to grow over the long term, and that's what you can fall back on. So really, I guess the final thing is the emphasis is different. So our starting point is to find companies that can grow sustainably over the long term, whereas I guess Gerardo will say they're looking for companies where the valuation is not punitively expensive, and therefore it gives them a better starting point. So for me, it's an interesting, because I don't know if this debate is often couched in terms of one is always going to win and the other is always going to win. I think there's opportunities for both, particularly if it's approached with a sort of long-term approach. But that's roughly how I would define growth investing.
Great, because I was muted. Gerardo, so now I go to you. So how would you define value in your case?
Yeah, I mean, I think Quentin did a good job in explaining some of the differences. Obviously, as active management, both in growth and in value, we all trying to find companies that are trading at a price that we believe is lower than it's really worth, that their intrinsic value. Now, the question is, where do you look for your ideas? And I think Quentin did a good job saying, in growth, their view is a company will do even better than the market expectation. And in value, we tend to look at things where we believe the outcome will be less bad than the market is expecting. So I think that is one good way of explaining things. We look at many things that are restructurings or through the cycle issues, whether when oil is trading at $24, $30 and the market thinks it's going to stay there for a long time, and we have a different view that the outcome will be less bad than that. Or if a company has a period of stagnant growth because of a product life cycle or a capex cycle, and we're looking through that cycle towards the longer term and think, the outcome of this will be less bad than the market expects, or that the market is just way too negative for some recent events. It could be a macro issue, a political issue, company-specific issue, but in general, it is that, with our assessment, our deep knowledge of the industry and the company, we feel that the market price is too punitive. Oftentimes, it tends to be going back to the CAPM model and why it doesn't work and things like that. I think one key assumption is that the market is and human.
Sorry, please mute, por favor, cerrar los micrófonos.
So I was saying, I think that people they say, okay, well, if humans behave in a rational way, if investors.
Gerardo, sorry, you're muted. I don't know. You touched something in your screen, but your microphone is muted. Okay. Okay.
Unmuting again. Yeah. So can you guys hear me? Yeah.
Yes, we
Okay.
can listen to you.
So I was saying that, you know, there's some assumptions that investors are rational and, you know, equally enthusiastic about good things as they are negative about bad things. But in our experience, you know, people tend to be very, very happy to keep winners and very enthusiastic about things that are going well. And they tend to be overly negative when things are going poorly. You know, people are very risk averse in that regard. So, you know, that gives opportunities to actually invest in companies where maybe things are not, you know, growing at 20 or 30%, but the value that the market is trading at is even more negative than it should be. And we are willing to invest in companies that are shrinking or not growing, as long as the expected return from doing that is a good one, which you can often find, because then many people don't want to own them. So that's kind of a broader view of how we look at value. Yeah, and yes, correct. Typically, you know, you tend to hunt for ideas or screen for ideas and, you know, things that are underperforming the market or things that are trading at multiples that are lower than their historical range and things like that. So you do tend up to be end up with a portfolio that has lower valuation metrics overall than the market.
Great. Something that has happened. So, and I think it's very difficult to say something is like, so prediction is something very complicated, as Niels Bohr said, especially when it's related to the future. But so one point that we are a bit surprised is what happened with value and with growth in the last 15 years. I would say 15 years. So I don't like to say 30 years. So growth has outperformed value. Perhaps the reason has been that perhaps we are not so technology is starting. So we are in the technological in the digital disruption. What do you think is going to happen in the future? Do you think that growth will outperform value for 10 years more? And I start with you, Gerardo.
Okay, so maybe it's a good time to introduce just a few of the slides that we have to share a little bit of the history of value against growth in the global marketplace, and then we can maybe start the discussion there, and then, you know, we can leave it to towards after the slides to expectation of what may happen in the future. So I'll try to share my screen here with the audience. So this is just the last 5 years, right? So we know it's even painful for us to show it as a value manager, you can imagine. But what this is showing, in summary, the gray bar, you know, that's on the right, shows the cumulative outperformance of value since those benchmarks were created. So for Europe since 74, many of these are in the 70s, some of the more mid-cap oriented from the mid-90s. Emerging markets since the mid 90s. So even with this last decade, that has been very difficult. If you look at the performance of growth and value since the inception of those benchmarks or those indices, value still is edging out an advantage, even though the last decade, and especially here in green, you see the last 5 years have been extremely painful for value. But even with that period, since those benchmarks exist, value is still outperforming. Granted, not as by much as it was before, but it's still the case. And then focusing on your question, on your comment of the last few years, I have this other slide which I want to share, which is, you know, what you were alluding to, which is the relative performance of value against growth for the MSCI world since the 70s. So every period of value against growth since the 70s is mapped here. And as you can see, there are periods where value is outperforming, and those would be on top of 100 in the index on the left. And it shows you how many months that period lasted. So yeah, there's been some great cycles. And as you can see here, one of the strongest ones for value was after the dot-com bubble burst in the late 90s. But as you point out, you are correct. This is the longest by far period of value underperformance. As you can see here, we basically have even over the last years have to change the axis, because before there was no period of value against growth that was longer than 90, 100 months. And now we're kind of breaking records of how long value has gone without outperforming, especially if you're looking at, let's say, rolling 3 or rolling 5-year periods. It's been very challenging. So I guess the point that I want to make is there are periods where value does better. There are periods where growth is better. I wouldn't advocate saying, oh, put all your portfolio into growth, put all your portfolio into value. I think a well-balanced portfolio has both to be prepared for different cycles, because these are typically hard to predict exactly when they're going to turn. But I think this gives you a good idea of how long this has been going on. And I just have 2 more slides to share. One is the relative valuation. So one thing we like to share with people is that after this very long period of value underperforming, where are the relative valuations? Because it's clear, as Quentin mentioned, growth companies, they have better fundamentals, they tend to trade at higher multiples. So what this is showing is, what are those ranges of relative multiples typically at, and where are we today? So on the bottom axis, you see different valuation metrics: price to book, price to earnings, price to cash flow, forward PE, EV to sales, and EV to EBITDA. These are really a variety of valuation metrics focused either on balance sheet metrics, on cash flow metrics, income statement metrics. Just these are, I think it encompasses a good range of what people use to value companies. And you can see here on the left axis, on the vertical axis, that value companies typically, basically since the 70s, they've tended to obviously trade at discounts to growth because they have better growth, so they'll trade at discounts. But those discounts in different metrics will be like 50% discounts or 30% for price earnings. For EV to EBITDA has been 20-30% discounts. The gray area shows you the plus minus 1 standard deviation of where those discounts have historically been. So it says it's maybe for price to earnings or price to cash flow, you can say discounts have been somewhere between 20 to 40%, and that includes plus minus 1 standard deviation. And then the green bar shows you where we are today. So this is just a matter of saying, after this very long period of underperformance by value, where are the relative valuations, right? So you can see here that on that historical relationship of discounts to growth, we are at a period where it's extremely cheap. And then the last slide I want to share is looking across geographies, and again, the same valuation metrics, but across geographies. And this is, if you were look at it at the valuation relationship between growth and value, and you look at percentiles, how cheap is relative to historical track record of growth to value. You can see here that in very many geographies, and most of them, we're almost at the cheapest it's ever been, right? In terms of the overall value landscape against the overall growth landscape. And of course, as value and as growth managers, we're not going to buy the entire value landscape. Well, we're making individual choices of where to invest to try to maximize the return. But this, if you were to just generalize and say, where is growth, where is value, this shows you that across all valuation metrics, across all geographies, value is at the cheapest that it's been relative to growth. And then the question that all of us have to ask as investors is, what does this mean for the next decade? Which is kind of the difficult thing to predict. But our view and our conversation with our investors is always that your entry point in terms of the price that you pay is the key determinant of your future return. And if you look in relative terms, this is one of the basically cheapest times in our history in terms of value against growth. And then I think that's where I leave it. I maybe hand it over to Quentin to give the other side of the coin. But basically, in summary, is that on that relative valuation, we've never seen a cheaper situation for value relative to growth. And then in growth, of course, as you mentioned, it's been very concentrated in terms of where the returns are coming from. My expertise is mainly in emerging markets, and I can tell you there that if you look at the strongest growth companies there, Tencent, Alibaba, Baidu, TSMC, Samsung, I mean, they are, those 5 or 6 companies have made an extremely high part of the total return. So if you were to look at the return of the index without the, let's say, top 5 companies, it looks very different. So it's been a period, as you mentioned, of extreme concentration. And you know, I've been investing in the emerging markets since the 80s and 90s, and I've never seen such a concentration where you have individual companies that are 7, 8, 6% of the total benchmark, right? So there's been extreme concentration of the returns also in technology. And the question is, can these, you know, $500 billion companies, 800 billion companies keep growing at the same pace? You know, it's getting harder the bigger you are. And let me unshare the screen.
Okay. Yes. Okay, Quentin, I go to you. So
yeah, I mean, one thing I was just going to, on those slides, I don't know if we come back to it, but I guess the one thing that sticks out, I suppose it's sort of a value investor's argument, is that you assume a level of mean reversion. And I guess that one with all the worms that were showing the long period of growth outperforming. And, you know, I think it's likely that there will be some reversal, but I guess it's missing perhaps what has changed since 1974 in that time, and how has the economy changed? And, you know, it's not necessarily, you can't assume that you'll get a reversion all the way back up, because, you know, currently the economy has shifted to being much more of an intelligence economy versus being an industrial economy before. So I guess that's kind of one thing. I think, you know, it leads to think I guess there will be some form of mean reversion, but it's wondering how much will take place given the level of technological disruption. But I guess maybe we can come on and discuss that at the end. I don't know.
all right. Oh, obviously, Quentin, I was going to ask you, but you have answered to us. If you think that this time is different, that there's a structural change, but I would like to go further with you, asking you if growth is only technology, or what do you include on top of technology among the growth stocks?
Yeah, well, I mean, I think we can maybe come back and discuss what's driven the underperformance longer term. But so in terms of growth stocks, it's anything that has a you know, a very strong secular growth driver behind it. I mean, for us particularly, we are focused on the quality growth area of growth, and that is, in a way, a conservative part of the market. I mean, it still needs to be growing strongly, but we're not looking at sort of pre-profitable companies or companies that are, you know, in early startup mode. And we have a fairly conservative outlook in that they need to not carry much debt, and they need to be capital light, which is very important for us. So that gives us a rich area to look at, but it does exclude quite a lot of sectors for quality growth, I suppose. I guess if I was to, should I go through the couple of slides I have, because it might raise a couple of points as well that Gerardo might be able to discuss as well, and then maybe we can come back to why value has underperformed as much as it has. So if you just wait 1 second, I'll just share my screen. Sorry, is that shared now? You got that?
No, it is not.
No. Oh,
No.
well, 1 second. Sorry. Should be now.
Yeah, you're starting now.
So just quickly, because I suppose one of the key things, as we said, is on sort of valuation multiples. And as Gerardo said at the start, value investors would often see a certain multiple as being prohibitively expensive because you can't get the returns that you want from it. And it doesn't give you enough margin of safety. And I think one of the things that's interesting that we've looked at, that what we believe is that actually a company can sustain a very high multiple if it has the ability to grow its earnings sustainably over a long time. Now, this is a theoretical slide here, and effectively it's assuming a company is starting on a multiple of 40 times, which I don't know, Gerardo, I would assume that you'd be unlikely to invest in a company on 40 times. Who knows, but maybe. And it shows that actually, if a company can grow at 15% earnings growth, which is, you know, that's high growth, but there are companies out there that have done it over the long term. it can actually sustain a big compression in its multiple and still deliver decent, share price return. So if you look at the second from bottom one, that is a company starting at 40 times that suffers a 50% PE compression over 10 years. But because it's growing its earnings at 15%, it delivers a 7% CAGR. And, I think there would probably be a question for if a company can carry on growing at 15%, could its multiple compress? But in any case, it's an example of where we believe actually the growth gives you the margin of safety, because it means that you can wear a huge amount of valuation compression. And just to move on from theory to the practice, you actually see this happening, say, with Alphabet or Google. So this is its forward PE multiple going back from 2005, which is when it peaked. And so in the middle of that year, it was around 60 times. And going forward to 2012, it suffered an almost 80% compression in PE. But because it was growing its earnings at 30%, it still managed to actually have a positive share price CAGR of 10%. And those are some other time periods as well that show that a stock that is continuing to grow its earnings can wear that share price, that PE compression. And I think it's interesting because, if you said to someone, would you invest in a company that's going to have its PE halving? Most people would say, no, thank you. But actually, the earnings growth can deliver a huge amount for the share price. But it's not just earnings growth. So this is why we sort of find looking at the multiples a little bit misleading, because for us, we only look at the valuation at the very end. So for our investable universe, we'll only look for companies that are growing. We won't pay any attention to its valuation. Having said that, there are obviously some companies that we won't be investing in because of our restrictions. We don't invest in IPOs, for example, because they need to have a track record. But the other thing, as well as earnings growth, that is required, just if I click on to next, is a decent level of return on investor capital. And I've thrown in a couple of formula here because it is a CFA presentation anyway, and I'm sure people enjoy a bit of revision. But this is just a reduction of the belief that the value of a company is the sum of its future cash flows discounted back. And this is a reduction of that. And what this is saying is the fair value of a company is not just based on its earnings growth rate and the discount rate in the market. It is also its reinvestment rate. And that is effectively the level of reinvestment that is required for it to grow at that earnings rate. Effectively, it's capital efficiency. And the lower the reinvestment rate, the higher the multiple a company can deserve. And I'll flick onto this last slide, which is a little bit busy, but what it effectively is saying is that you can have two companies that are actually growing at the same rate, but if one has a much higher return on investor capital or a lower reinvestment rate, it can be deserving of a much higher multiple. And there are various sort of reasons, sort of mathematical and financial, behind that. But that to us is the key thing why we're firstly sort of comfortable investing in high PE companies, because if they have strong earnings growth and they have a high ROIC, then in many ways they're actually deserving of that high multiple. Now, obviously, at times certain companies can run ahead of what that valuation is, but for us, that's why we always come down firmly on the growth rate rather than the valuation. And so, part of what's required for this, though, is then being able to forecast out cash flows, and that requires a very specific sort of company. But hopefully this gives you a reason why we believe that the value of where you're investing is very important, but it's about a lot more than the multiple of that company. Hopefully that's sort of helpful. I guess one thing which we can come on to, I suppose this now comes back to the point about, is it mean reversion, or has technological change changed something in the market? And one thing that lots of people sort of have pointed to and is clear is that as you've had technological change, and this is my last slide, by the way, before we get, you've had a rise of intangible assets in the market. So this is what I mean about moving from an industrial economy to an intelligence-based economy, and effectively, the preponderance of software and technology. And this is very important again for valuations, because as tangibles have risen, those companies that, sorry, as intangibles have risen, those are not then classified on the balance sheet, and they're expensed through the earnings. So what this means for, say, a tech company who invests, $100 million in R&D and developing new software, unlike an industrial company, if they invested the same amount, that industrial company would put it on the balance sheet, which would therefore boost its book value and reduce its price to book. And similarly, it would, because it's being depreciated over long term, it's not hitting its earnings, its P&L statement, and therefore its earnings would also be boosted, which would reduce its PE. Whereas all these tech companies are expensing it in that year, which is holding down its earnings. So the question is, has actually this change to a new economy? Does that mean that actually these companies are not correctly sort of assessed by the traditional valuation metrics? And I think it suggests again that this is one thing we say, and Gerardo may disagree, but traditional value companies may be looking cheaper than they really are because they don't have as many of these intangibles residing within their balance sheet or in the company.
Okay, so it's 1936. We want to have this conference around 40-45 minutes, but I want to ask you two important questions. And the first one is, how do you assess the current valuation level that we have right now? And the second is, how do you think value or growth stocks are going to act if we see a rise? I wouldn't say in interest rates, I would say about the whole yield curve. Okay, so first question, Gerardo, how do you see the current valuation level, the general level on one side, but also of the value stocks on the other side?
Yeah, so on a general valuation level, I think things are not cheap, right? It's I think in this case, you can always find individual ideas, put a portfolio together. We tend to have 50, 70 holdings, so I think that's still possible. I would say relative to the different moments that I've seen in my career since the mid 90s, in terms of all the Latin America crisis that we had in the 90s, Turkish, Russian crisis. These are all in emerging markets, but subsequent to that, I joined Brandes basically during the dot-com bubble, and I've seen the years after that, and global financial crisis was in the middle of it. I mean, those were very significant periods where there's lots of opportunities. I think today there's a lot of enthusiasm in the market, especially relative to how some economies are doing. So I would say it's not a period where you can find bargains left and right, and you have to do more due diligence to find great investment ideas. Geographically, though, I would say that the US is a little bit more enthusiastic in its valuations, and we as a firm tend to see better opportunities in areas like Europe and emerging markets than in the US itself, and in different sectors as well, in terms of where there's maybe less enthusiasm. And so in general, we see just a better case for relative performance in areas like Europe and emerging markets, while at the same time admitting that is not the cheapest moment that we've seen. So in the case in terms of the equities, I think is maybe just my recommendation is shifting your allocation towards maybe there's a lower level of just enthusiasm, and valuation levels don't look as elevated. And then, by the way, I'm saying valuation levels, you can look at index PEs or cash flow levels, even if they're sector adjusted, right? So obviously we know technology is a bigger part of the indexes and different indices right now, but even intra sector, you can see valuations are on the higher side relative to history. And then the question I think great question that you ask in terms of what happens if the yield curve moves, right? So I think that as interest rates go up, there's let's say a higher discount rate, and those companies that have cash flows very much into the future are going to take a disproportionate hit in the valuation compared to those where, let's say, the aggregate duration of the cash flows is closer to you. So if today we're buying companies that may not be growing as much, but they're already giving us a 10% free cash flow yield today, you're going to have a bigger percentage of your net present value in the next 10 years compared to the cash flow that exists after 10 years. And I think that maybe there's a little bit more of a sensitivity to valuations where the valuation, the heft or the bulk of the cash flows are created after year 10. So I think that if we do see interest rates go up, that people will start maybe putting a little bit more of a premium on companies that already have those free cash flows today, and they have high dividend yields. Today we can find companies where we get 9%, 8%, even 10% dividend yields. These are mainly in some emerging markets, but even high single digits in developed markets, simply because some investors don't want to buy companies that are not growing. Yet I would say that the yield premium that we're getting over the sovereign yields is very attractive, right?
Mm-hmm. Okay, Quentin, you are I would say, in the weak part of this question, obviously, because if valuations are high right now, or the market is not cheap, so we see it's because technology growth stocks are very expensive. How do you see the global valuation of the market on one side? How do you see the valuation of the growth stocks? Or for us, if you can distinguish between quality growth stocks, as you told before, and the other growth stocks. And finally, how do you think the growth stocks are going to perform if we see a general movement of the whole curve, obviously upwards?
Yeah, I mean, I think, if you look at it objectively, valuations have moved up. They are higher. They're above their average rate over the last 25 years. I think one of the things that we look back to, though, is what is the backdrop behind that? And the key thing to note is that interest rates are at historically low levels. So in fact, if you compare equities to bonds, they still look relatively attractive. The earnings yield versus the bond yield, as Gerardo also mentioned there, dividend yield versus sovereign yield. So in some ways, objectively, things they look expensive, but in others, actually, they look relatively okay. And that's especially the case when you see the level of liquidity and monetary stimulus that has been pumped into the system. When you have those factors supporting it, who's to say whether these valuation levels could hold for a while? No one's saying they're going to crash right back down again. And I think this is sort of part of the whole sort of global macroeconomic political situation is slightly shifting now, with governments with so much debt. The question is kind of, where are things going to go to from here? And in some ways, we're in a slightly different situation to the period we have been in for the last 20 years. So it's kind of, I agree that valuations are higher. What growth stocks and quality growth stocks, they've had a couple of good years, and our return profile of some of our funds has shifted down. But that's not to say that they can't continue forming through this period if interest rates, stay low and there's no inflation or growth around. Those are the questions. Then, sort of going on to your second part, is what is the outlook looking like from here? And it feels like there are some inflationary forces there, and it feels that maybe interest rates are going to tick up over the next 10 years. But are we going to go back to having sort of 5% interest rates? It seems quite unlikely, given the level of debt in government. So perhaps we're into an environment where interest rates move up very gradually. It's just hard to see how governments will get out of their debt levels in other ways. So I guess that's kind of how we view the situation, and how I view the situation at the moment. I suppose the other question, which Gerardo mentioned around interest rates, is that is true, that if you were in a rising interest rate environment, the long duration assets get penalized for it. But I think, again, this comes back to, if you can find companies that are able to have pricing power and can grow their cash flows ahead of any inflation that there is, then they should actually benefit from improving cash flows. And whether or not the increasing interest rate is enough to offset that or not, well, that depends on the degrees. but it doesn't necessarily mean that all growth companies with long duration cash flows are going to be penalized heavily if you find the right ones. So that's kind of how I view things. I think the other point to mention is you mentioned sort of tech stocks inflating the whole economy. There clearly are there's a certain area of the market that is very expensive, and that is, you saw it with IPOs last year. This is pre-profitable companies with huge amounts of money sloshing around and boosting their valuations, on 60 times sales, let alone 60 times earnings. And that's where it feels, that area of growth investing would feel quite uncomfortable. But where we are focused, which is a little bit more conservative, as I've said, it might sound odd to be conservative to Gerardo, as I say, but we're more comfortable with those companies, and that's because they provide defensive characteristics. And we believe that even if there is a period of slightly increasing interest rates or higher inflation, these companies can sort of get through that. But it's a really interesting time. I mean, as Gerardo says, the disconnect between value and growth stocks is the largest it's ever been. But we are also at a time of, we've just had the last year where all these technological trends have accelerated ahead, and I don't think those trends are going to reverse. They're going to continue accelerating. So there is a question, and I don't know what the right answer is, but what does that mean for the companies that can benefit over the next 10 years? Yeah, that's what we're all trying to grapple with and try and understand.
Great. Let me ask with our audience. Oye, aquellos que queráis, sorry, I will say it in English. Please question. I'm looking at the chat and I don't see any question for our speakers. So write, please, the question that you want to place to the speakers in the chat. Nicolas, I see you there. Nicolas Bourdet, please. Why didn't you make?
Yes, I just thought it's been a very interesting. I thought the charts were great, and clearly, inflation is a big question. Will all these measures be inflationary going forward? All the stimulus that's coming down. I wanted to find out really what companies you own that have, which of the companies that you own, Quentin, that have especially good pricing power. And then Gerardo, we saw results today from the energy sector, and I was just wondering really if you still believe in banks, if you still believe in oil producers, whether you still and actually there's another issue here, whether we're going to see a commodity a new super cycle as Goldman Sachs predict, and whether that would be a good tailwind for value stocks.
Okay, so I'll answer very quickly on the pricing power. I mean, there's various companies that have pricing power, and many of them it's because they have dominant market share and they're providing a service that is indispensable for their customers. So many of you will have heard of mission critical, non-core. These are essential items for their customers, but actually that represent a very small portion of their overall costs. So an example of this is a company called West Pharmaceutical in the US. They make sort of syringes and vials that's used in drug products across the world, and they have very high market share in these glass and vials and rubber stoppers. But for the drug companies, who are spending billions of pounds developing drugs, the cost of these rubber stoppers is very small, and so West can put through pricing consistently every year without causing pain to their customer. And in many ways, the customer is happy to well, I don't know any customers happy to pay higher prices, but they're very willing to take it because West has such expertise, and they know that with West, they're gaining a level of quality and assurance that they know they're not going to have higher costs from having drug recalls further down the line. So that's just a very quick example, but most of our companies have some degree of pricing power. Some is higher than others, but that allows us to be comfortable that these companies can continue to grow ahead of the market even in an inflationary environment.
Okay, so now I'll maybe answer the ones directed to me. I would say yes on financials and oil or basic commodities. We still like several companies. I think on the financial side, the ones that we're most exposed to, at least in the portfolios that I manage, are ones where you have seen a lot of NIM pressure, or net interest margin pressure, but the banks have a good level of loan growth still remaining, and they're being able to take cost out of the business. So I guess one of the advantages of technology that I've seen in companies that I'm very familiar with, like banks and telcos, is that you are able to really change your operational procedures a lot, and you're able to reduce your expenses in a meaningful way to bring your cost income ratio down. So there is a little bit of an offset, but if we see rates go up, and in some countries we do it, I expect to happen eventually, that the sensitivity to the NIM can be very significant. So yes, we still have exposure to some financials. I would say, at least on the emerging market side, is probably closer to equal weight, and is very selective. And we tend to have more of the companies that still have a degree of under penetration of financial services, and there's still some growth to go. We have some banks in India and Indonesia. I'm talking more on the EM landscape. I mean, we also have some in Europe and the US, but on the EM landscape, they tend to be shifted toward where, loan penetration is still low. On the oil side, similarly, we have exposure of some Europeans and US companies. And on the EM side, we tend to focus on the ones that are really on the low cost area, right? So we have investments in Russia and in Brazil that are, have very, very low lifting costs. There is a little bit more of a sovereign risk element there, but, we own companies, for example, like Lukoil, where you have high single digit dividend yields. And let's say if there's oil prices stabilize or even go down, they still have high profits because their lifting costs are so low. And in the case in Brazil, we own Petrobras. Is one of the companies with the highest volume growth in terms of production, in the downstream. So yeah, we still have, we like some companies there in both oils and financials. I think you had a question overall in commodities, but I think it's hard to generalize the super cycle in commodities because there's some areas that we believe are overvalued. Let's say lithium, for example. We've owned SQM in Chile 2 times in the last decade. And right now we think there's so much enthusiasm for green energy that there's probably more supply of funds than there is actual companies that you can invest in at reasonable valuation. So we see a lot of let's say froth or overpricing in issues like lithium batteries, clean energy. There's a lot of examples where valuations have gotten out of hand, to the multiples and multiples of revenue that are in the dozens or even hundreds, or even on the electric vehicle side, that's related to this, just some valuations are extremely high. So I think it depends commodity by commodity. It's difficult to generalize, but in some areas we do still see opportunity. I would say highlight oil and gas. We see opportunities there. And it's probably, people don't talk a lot about this, but we have across the firm, across US and emerging markets, also exposure to uranium, which we feel was very cheap. It's beginning to recover, but still a good opportunity there in terms of basic commodities. And we own a company that is in Russia, does diamonds. It's one of the second largest extractor of diamonds, called Alrosa, which is also so the diamond area we also see as attractive.
Great. Short answers, please, because we have some questions. The first question is from Ignacio Fernandez Montes, and he would like to ask both of you how potential regulation may impair the network effect and pricing power of expensive tech companies.
Yeah, I guess that's one of the big questions around the likes of Facebook and Google and Amazon and all these companies. This has been going on for a few years now, and I guess some of the volume is being turned up as to what is going to come through. As far as we're concerned, we're only invested in Google, and I would say I don't know if Google actually looks especially expensive. It only trades on 24 times. Not that we use multiples, but on those equations, it's not. It's one of the, and for us, it's one of the ones where its DCF implies a better return ahead. I think the question always with these things is, as much as governments are grappling with how to sort of regulate these companies, but they are still providing a huge service to customers and consumers. And so often the comparison is made to sort of the breakup of big oil years ago. But the difference is that consumers aren't getting hurt here necessarily. You know, consumers are still getting a service which is ostensibly very good value. So there needs to be a level of regulation, but I don't know if that regulation is going to come through and harm their network effects. It might mean that they have slightly higher costs that come through. It might mean that they have to implement certain new restrictions, you know, be it for Twitter, you know, maybe they have to monitor what people are saying more and have more of a role that is more like a publisher than what they've done so far. So I think it's even though it's been going on for a long time, it's still too early to say how it will affect, but I don't think it will necessarily harm their network effects. You know, perhaps it might increase costs or something like that.
Great. Another question for you, Quentin, from Alex Tomala, and she's asking, how do you see the regulatory risk, especially in the coming 2 years? So not in the long term, so we have the risk, but do you think we're going to have a dramatic change in regulation in the following 2 years?
Well, yeah, I mean, as I just said, it's hard to predict exactly what's going to happen over the next couple of years. I think I can't see there being a landmark regulation coming through and breaking up Google and Amazon, as I've said, because of the harm this would cause to consumers. And I think this will be an ongoing debate that happens sort of gradually over time. I'm not, you know, in politics, so I wouldn't be able to tell you what is happening, but this is clearly, you know, very complex work that's happening. You know, in the US, there's huge public interest, huge interested parties who will be debating with the Senate. And so as much as there are some people who have big tech in their crosshairs, this will be I would view this as being a longer process than something happening immediately in the next couple of years. And, you know, apart from anything else, you've already seen this with Google and Facebook trying to, and others, trying to sort of already sort of put things in place so that they are less likely so that they can appease the regulators, if that makes sense.
Great. We have a question from Gonzalo Tomé for both of you, but Gerardo, if you don't mind, I would ask you to answer this question. Is how does a value manager take into account the value of intangible assets?
Yeah, so I think you have enough information in the financial statements to make adjustments for that. So whether they're in the income statement or the cash flow, or they're amortized or not, or depreciated or not. I mean, we see, you know, the investment it takes, and it's a question of what's the value that they have. So even before they were on the income statement, we were already basically taking it and put it into the income statement to get more of a cash equivalent earnings, right? So we always make adjustments using the data that we have to basically fix what we think is not really realistic from an accounting perspective. That's part of kind of the due diligence that we do. And you kind of think, okay, what's the value of this, right? So it depends on the nature of the goodwill. If there's a big acquisition and we think they overpaid, then maybe that's not really something valuable. But if they're investing in some cases like, you know, customer list or technology that is showing that it can give you a ongoing return on that investment, then yeah, there's value to it. And sometimes it's difficult to pinpoint exactly where the value is. If you look at pharma, you know, pharma is spending hundreds of millions of dollars and you don't really know exactly what's going to come out of, you know, each dollar. So you have to make some assumptions based on the historical return of that R&D. So depending on the industry is kind of what the analysts look at, and they have different ways of adjusting for it. But we always make the point of showing the committees or the portfolio managers, you know, what it really looks like in terms of the capital required and the return that you get on it.
Great. I have a question from Alirio Sendrea, but Alirio, I think since you're asking about regulation, I think more or less the question has been answered. If you want to unmute and place the question, if you think it's not covered with the answers that we have received before. Okay, Alirio, indeed, is what he said that is already answered. Okay, thank you very much, Quentin. Thank you very much, Gerardo. I think it has been a great presentation from both of you. I'm surprised. I feel very proud of having the CFA charter because you, Quentin, have the CFA charter, because Gerardo, you have the CFA charter. I think you have shown us how powerful is our education. Thank you very much. It has been extremely interesting. Nicolas Bourdet, thank you very much for your support, for capital strategy support. I think it has been a great session for us. Thanks. Bye.
Thank you very much.
Muchas gracias, Gerardo.
Muchas
Thank you very
gracias.
much.